You ever stop and think about what really keeps your money safe in the bank? It's something we just assume is going to be there, right? But believe it or not, the system that protects your cash was born out of a century of total financial chaos. So let's get into the incredible story of how we got from panic to protection. Okay, so it pretty much all kicks off right here. Check this out. It's December 24th, 1913, Christmas Eve of all days. President Woodrow Wilson signs this new currency law. And the headline here is screaming, "Dawn of a new era in business." And look, this wasn't just some boring piece of legislation. No, this was the blueprint. This was the foundation for the entire American financial system that we know today. But that makes you wonder, right? Why did they need a whole new system? I mean, what was so fundamentally broken that they had to completely rip it up and start over just to make sure our savings were secure? Well, the answer, it's a history full of these absolutely brutal financial crises, one after another. So let's talk about that history. Because before the system we have now, the American financial world was basically the Wild West. Seriously, there was no sheriff in town, no safety net at all, and financial panics, they weren't a bug. They were a regular feature. Just try to picture this for a second. A rumor starts going around that your bank might be in trouble. What happens? Everybody, and I mean everybody, runs to the bank to pull their cash out. But guess what? The bank doesn't have it all sitting in a vault. They've loaned it out, so they can't pay, and the bank just collapses. And poof, your life savings? Gone. This was real life for people in the 19th and early 20th centuries. These bank failures could destroy families and businesses in the blink of an eye. The straw that finally broke the camel's back was this thing called the Panic of 1907. It was so bad, so severe, that Congress finally had to say, okay, enough is enough, we got to do something. And that led directly to the Federal Reserve Act in 1913. But get this, even that wasn't enough. The stock market crash in 29 and the Great Depression that followed, that showed everyone the system needed an even stronger foundation, a real safety net for regular people's money. And that's what we got with the huge Glass-Steagall Act in 1933. All right, so the first big solution, the first major piece of this puzzle, was creating a brand new institution to basically watch over the entire banking system. And that's where the Federal Reserve comes in. And here it is. This is the heart of the operation, the Board of Governors headquarters down in Washington, D.C. The whole idea here was to finally have a central, steady hand to guide the nation's finances. And really, that's what a central bank is all about. At its core, the Fed was built for one big reason: to give the country a financial system that was, and I quote, safer, more flexible, and more stable. You know, it was supposed to be the adult in the room, finally. So what does the Fed actually do? Well, you can kind of break it down into four key jobs. First, they manage the country's money supply to try and keep the economy humming along. Second, they supervise banks, basically making sure they aren't doing anything too risky. Third, they step in to try and contain big financial crises. And fourth, they're the bank for other banks and for the U.S. government itself. You know, the Fed actually has a perfect analogy for what it does. Think about it like this. Banking is a sport. The banks are the teams on the field. The Fed? The Fed is the referee. They're not playing the game. Their job is to watch everything, blow the whistle when someone's out of line, and just make sure the game is played fairly and safely, so one team's crazy play doesn't bring down the whole league. But here's the thing. The Great Depression taught a very hard lesson. Even with a ref on the field, the game could still get out of control and people could get seriously hurt. The country needed something more. One last critical piece. A real, actual safety net for you and me. I mean, the number of banks that failed in the early 1930s, it's just mind-boggling. People's confidence in the entire system, it just vanished. And that's when Congress had a big realization. It's not enough to just watch the banks. You have to directly protect the people, the folks who trust those banks with their money. And their solution? It was called the Federal Deposit Insurance Corporation. You know it as the FDIC. And this idea was an absolute game changer. The government itself would insure your money using a pool of cash that the banks themselves paid into. So all of a sudden, if your bank went under, you didn't lose your life savings. This was so much bigger than just money. This was about restoring faith in the whole system. Now get this, when the FDIC first started back in 1934, the insurance limit was only $2,500. I know, that sounds like nothing to us today, but back then, that was enough to cover almost every single person's account. It was a massive first step toward getting people to trust banks again. Okay, so let's jump to today.
That little safety net has grown a lot. The limit's been bumped up over and over again to keep up with the times, and today it stands at a whopping $250,000 per depositor per bank. That core idea from the 1930s is still the absolute foundation of our financial safety.
And the folks who wrote that Glass-Steagall Act, they had a really clear mission. They wanted to build a wall between the normal everyday banking that we do and the super risky world of investment banking. The idea was to stop banks from basically gambling with your money on Wall Street. The goal couldn't be simpler: make banking safer and better for everybody.
So, okay, we've got the referee, the Fed, and we've got the safety net, the FDIC. All this has made our banking system incredibly stable, which leads us to a really practical question for right now. Since the system is so safe, where should you actually put your money?
We know the money's protected, right? So what's the real difference between a bank and a credit union? On the surface, they look kind of the same, but it turns out there are some really big differences under the hood.
Okay, so here's the biggest difference right here. Banks, they're for-profit companies. They have shareholders, and their main job is to make money for those shareholders. Simple. Credit unions, on the other hand, are nonprofits. They're actually owned by their customers, who they call members. So their main goal isn't to make a profit for investors, it's to serve their own members.
And that one difference in how they're set up leads to some real trade-offs for you. Since credit unions give their profits back to their members, you'll usually find lower fees, better rates on loans, and higher interest on your savings. So what's the catch? Well, big banks usually have way more branches and ATMs and a much bigger menu of products and services. Let's take one specific thing: overdraft fees. We've all been there. On average, you're going to pay a few bucks less at a credit union than you will at a bank. It's not a huge difference, but it's a perfect little example of how that nonprofit thing can save you real money. But listen, here is the most important thing to remember, the big takeaway. It doesn't matter which one you choose, a bank or a credit union. Your money has the exact same level of federal protection. Banks have the FDIC, credit unions have their own version, the NCUA, and both give you that same rock-solid $250,000 guarantee. Your money is safe. So here we are. After a whole century of panic and reform, we've landed on a system that is fundamentally built to be stable. We've gone from the absolute chaos of bank runs to a system with referees and federal insurance. The foundation is solid. And that brings this whole story right back to you. All that work, over 100 years to build a stable system, it's done. So now the choice is just about what works for you. What do you care about more? The huge network and all the services of a big bank, or the lower fees and member-first vibe of a credit union? Because at the end of the day, with your money protected no matter what, the choice is all yours.